This is the Daily Market Rundown live from the Tradelo trading floor. It's April the 3rd. Some highlights from today's show. Trump liberates the dollar, VIX holds a key clue, and US services data is now in focus. A good day, traders, and welcome to the Daily Market Rundown. A number of things going on, of course, across the board. So let's get stuck straight into our first topic for today, which is ultimately Trump liberates the United States dollar. Now, again, this is not necessarily a bad thing. Let's take a step back quickly and discuss what are Trump's objectives ultimately for this presidency. He wants lower rates. He wants a weaker dollar. He wants to ultimately remove some of the trade deficit that ultimately the United States has. Now, on two fronts, he, of course, is getting what he wants, which is lower yields, and now, of course, very much a weaker United States dollar. And ultimately, he is also going to get quite a substantial amount of revenue coming in via the tariff. So net to net, he's getting pretty much exactly what he wants at an objective level. Now, of course, it doesn't mean there aren't repercussions for these decisions. And that's ultimately what we're going to learn about today, tomorrow, and of course over the next couple of quarters. Now, let's get stuck straight away into it. What ultimately was announced yesterday was some form of reciprocal tariffs with a minimum base of 10%. Now, the minimum base of 10% was done on purpose. What it ultimately means is that countries cannot move their product into lower tariff countries and ultimately sidestep some of the tariffs that the US is demanding. So if, in essence, it removes the ability to cheat the tariffs. That's why the 10% sort of levy was imposed at a minimum threshold. Now, on top of that, ultimately what he's done is he's kind of looked at each country. He said, well, what is the trade imbalance between your country and my country? He's then ultimately worked out what the percentage is in terms of trade deficit, and he's then divided it by 2. It is that simple. There's, of course, quite a bit of embarrassment hitting the headlines. We'll talk about this in a moment, of the approach they've taken in terms of working out the reciprocal calculations. But at face value, ultimately, what they've done is they've just imposed a significant amount of tariffs across the board against all of their key trading partners. Okay. Now, the net release, the total release, what we've seen overnight was a lot worse than what was expected. If we just take China, for example, coming into yesterday, China had a tariff of 20%. They now have a tariff of 54%. Okay, that is a significant hit to the Chinese economy at a time, of course, when China is very much not growing, is suffering from deflation. So again, we can see just, the second biggest economy in the world is not exactly going to be having a very good time as a result of these tariffs. Now, what comes from this? Well, I think there's a number of moving parts, and I think the first thing to ultimately remember and keep in mind is that in the near term, this will prove to be inflationary. It will prove to have an impact on growth, and whether or not this will impact the medium to long term, that of course depends on how long these tariffs stay in place. Are they going to stay at these maximum rates? Are there going to be negotiations had between a number of countries? So there's a lot of moving parts, and I think that's why you've got to be very cautious in sort of concluding that this is good or this is bad, okay? Because there's a number of things that can happen over the next couple of days, and of course, don't forget, like I said, Trump's objectives at face value is weaker dollar, lower yields, and a reduction in the deficit. But equally, he has got to safeguard the US economy going into recession. Okay, that is a priority for him, and ultimately, he will take a step back on the tariffs should we start to see quite a significant slowdown in the US economy. Okay, so it's very, very important to stress that, it's not just that he wants to impose these tariffs. He's not a complete idiot. He is very much aware of the implications of this tariff policy. So there's a couple of things, of course. Bloomberg Economics is talking about the average US tariff rate went from around 2.5% to 16%. Okay, now if you had a look at Goldman's forecast, they were talking about an average rate across the board for nations around 15%. So very much the US tariff rate now is just significantly higher than what it was and what anyone had expected. Okay. Now, what is key? There was a little bit of a news flow about how ultimately the administration calculated these reciprocal tariffs. A little bit of embarrassment in the sense that if you're going to do reciprocal tariffs, you ultimately need to go and look sector by sector, good by good, and actually work out what percentage tariff is being imposed by each country, work out some form of a weighted average. What they've in essence done is they've just said, look, we buy so much good from you, you buy so much good from us, the difference equals X, and they've then gone work out what the percentage is, and they've said that's the reciprocal tariff, okay, which is very much a problematic way to do it, because it assumes that ultimately everyone demands the same amount of product from each other regardless of what they're selling. Okay, so it's almost a very a childlike way to ultimately determine what the tariff rate is, which is perhaps why ultimately the administration said, look, we'll just divide it by 2. Okay, I think what very much becomes clear from the approach that they've taken is that they are sincere when they say they want the tariffs, but equally the thinking is that ultimately there is going to be a lot of negotiations to be done, and ultimately every country is going to have to reduce their tariffs to get ultimately the US to respond with a lower tariff on their side. Okay, I think that's the general thinking in the White House, which is, look, hit them hard, keep it nice and simple, don't try and overcomplicate and go and spend months and months trying to work out the actual reciprocal tariff. Just keep it clean, keep it simple, work out the imbalance, and force each country into negotiating and removing some of their tariffs. Okay, that seems as though what the playbook is. Now, that can be construed as positive or negative, and I think we're going to find out which it is over the course of the next couple of days, and it'll come down very much to the reaction function of the likes of China, of the likes of Europe. Okay, should Europe say, look, we're going to negotiate, we want to remove these tariffs, ultimately the market's going to begin the process of climbing that wall of worry. Why? Because like Besson said yesterday, so long as no one reciprocates, this is as bad as it gets. Okay, now if this is as bad as it gets and it doesn't get worse than that, and no one ultimately retaliates, what we are likely to get 3 months from now, 6 months from now, is a very different tariff regime to what we have today. Okay, so I want to stress that the market is, of course, now got a lot of uncertainty, and it needs to price that uncertainty, and ultimately needs to get to work to pricing that uncertainty. But like I said, if this is as bad as it gets, at some point the market will price that as bad as it gets, and then ultimately it can only get better from that point forward. Okay, also I must stress, if you were listening to the press conference, notice how Trump very intentionally told the market that the next steps is now for them to focus their attention on cutting taxes. Okay, so very much trying to shift the narrative away from tariffs being bad towards, hey, look, we're going to have all this revenue from tariffs, and now we're going to start cutting your taxes and making America wealthy / great / amazing / the best place in the world to be on earth type thing. Okay, so that's the key thing to stress, is this is as bad as it gets. Now, that doesn't mean necessarily that it's done for the markets, and of course that's what we need to get to. Okay, we're seeing a number of revisions from a number of banks talking about PCE prices being revised up 1 to 1.5%, as well as growth being revised down. It continues that theme of stagflation, and ultimately this idea of a recession and recessing pricing is of course rising as a result of that. Now, it's one thing knowing the theory, it's one thing discussing the implications, it's one thing having an opinion, it's another thing ultimately understanding exactly what the market thinks, okay? Because it's not about what I think, it's not about what you think, it's about what the market thinks. And that's where we need to get a good understanding, a good grip of things. Now, the best place to look is the rates, okay? If you look at the rates markets, we can see they've put on another 15 basis points of cuts over the course of this year. So we're talking about 3 cuts in the US now, and don't forget, just 2 weeks ago the market was very firm that it was only going to be 2 cuts. So we've already put on another cut, and what this points to ultimately, and this is important to stress, the way the market is interpreting this is that the Fed is going to prioritize growth because they still have restrictive policy. So ultimately the market is leaning on the fact that the Fed can perhaps cut a little bit sooner, protect growth ultimately, because the inflation expectations are very much going to be transitory. Okay, Powell alluded to this in the previous press conference. He told us his belief is that inflation will be transitory and they will most likely look through it. Okay, why? Well, again, they were telling us that ultimately it's a one-off. It's one of those things that it hits the market, it comes through the market, and then of course washes out via the base effects the following year. And of course, with all the uncertainty that's going on now with regards to are they going to remain, how high are they going to remain, it's very unlikely the Fed's going to suddenly shift their mandate and say, look, inflation is now a concern and we're not going to cut at all. Okay, don't forget, the Fed is very much in the game of managing and taking out insurance against a recession or a slowdown. Okay, so net, the market thinks rate cuts are coming. The market thinks that rate cut comes, of course, as soon as May. Okay, so rate pricing is now very much ramping up for the May meeting. And again, we'll talk a little bit about this tomorrow because we do, of course, have Powell coming in tomorrow. Now, with that in mind, what that means is dollar's getting smoked, okay? Dollar has been hit very aggressive. It doesn't matter what currency you're trading. The dollar is getting sold. And it's on this thesis that ultimately, because there's going to be a little bit of a slowdown in growth in the US, the Fed is going to be allowed to cut back towards neutral a little bit quicker than everyone expected. As a result, everything's flying up the page. Okay, that's no different for the euro. We can see euro, which got hit with a 20% tariff, which would be significant at face value for the European economy. We can see the euro's up just shy of 2% on the day. And in terms of key areas, well, there's no real resistance up until that 111.50. So clear blue skies, of course, for the euro. There is the dollar index, and you can see it's the same thing to the downside. There's very much nothing protecting the dollar now from further downside. And again, I don't expect this to change anytime soon. We are seeing particularly the risk-off currencies outperform. Think Swiss franc, think yen. They are the ones that are really outperforming against the dollar. So again, it's very much a sell-only dollar environment. Why? Well, because the Fed ultimately can now cut. Now, there's a key clue coming in the VIX, and I think this is going to be something to pay very, very close attention to today. Because like I said to you, sure, at face value, this sounds pretty negative. Okay, at face value, read a newspaper article and you're shitting yourself. You're thinking the world's going to come to an end and a recession is imminent. But time and time again, I've done this job for long enough to know that you very much need to remove your bias and opinion from the equation and trade what you see. Okay, because this idea of climbing the wall of worry is a very real thing. If this is as bad as it gets, as Scott Besson says, and we now have some clarity, I could very much see a case 3, 4, 5 weeks from now where we begin to rise back up towards highs. Why? Well, because now we have clarity. Now we have rate cuts, taxes, tax cuts coming, and of course deregulation. And that's all very, very positive, not just for the economy, but growth in general and global growth in general. Okay, so very, very important is just remove your bias from the equation and focus on what the markets are telling you. Now, the VIX is one of those markets that I think is going to be key today. You can see, of course, we had that extreme volatility overnight. We had some very, very big gap moves in the futures. VIX is sitting elevated, but it's sitting elevated very much lower than where we made at the start of March. Now, what happened to get this VIX up at the start of March? Well, it was Trump telling us that Canada, Mexico, you're going to get whacked with 25% tariffs, and I'm going to retaliate and put tariffs on everyone. Okay, VIX spiked up to 30s. And then we of course subsequently sold off all the way back down to 17s, and we started to rally into the Liberation Day announcements. Okay, Liberation Day has now happened. The VIX has spiked back up, but we have got that lower high. Okay, now this is the key. This is going to be the clue. This is going to be the thing you need to write down and make sure you switch on for today. So long as that VIX high holds today, if we don't take out that high in the VIX today, what that's telling you is that actually the environment is not that bad as expected. Now, I'm not saying ultimately that VIX is suddenly going to get squashed, but what I am saying is if you can't take out that high in the VIX, what it suggests to you is that this is as bad as it gets for now, and that ultimately there is this anticipation or this expectation that we are going to start to see the EU and China all put up their hands and say, let's talk, let's have a conversation, let's get these tariffs low. Okay, and what that would mean then is we should start to get that squashing effect in the VIX, and we know so long as that VIX doesn't rally to the upside, it will be a little bit more of a conducive environment at some point for people to start dipping their toes back in and buying the market. Now, is that day to day? Perhaps not. It's not something you want to be really focusing on. I will, of course, get to the S&P technicals. The key level for today, this is it. It's as simple as this. You get above 56.50, that environment's going to be very conducive. At that point, you're probably going to see the VIX close that gap up. And at that point, you're going to see an ugly short squeeze back up towards that 57.50. Okay, 56.50 is huge in terms of everything that matters. We get above there and all bets are off. effectively the tariff concerns and problems will be in the distant behind. But so long as that 56.50 holds, as long as we don't get anywhere near that level, you've got to be betting at some point that we are going to stage some sort of an offer down today. Okay, the markets are nervous, they are sensitive. Like you can see that we have got a VIX sitting around 25. So it's not an environment where you want to be smart. You don't want to be buying that market until we get back up above that 56.50. Okay. It's very much an environment where hedging will be to the downside, outright flows will be to the downside. It's just not an environment in which you want to be a buyer of the market. Okay, so that's the key sort of technicals for the S&P 500. You can see, of course, we did have that gap overnight. We're kind of holding on to that gap. I think the overnight range is going to be important. Typically what happens when you get these very big overnight moves is you get a sort of the market staging a big initial balance. So don't be surprised to see the market have a very, very wide initial balance that just sits in the lower range of the overnight move. Okay, so think 55, sort of 75 as a high, and of course perhaps a little bit of an extension on that overnight low. Okay, so keep a close eye on that. I do think today is very much a sell rally day until, of course, we get above those 56.50s. Okay, with that in mind, of course, another key chart is break-evens. Okay, there's been quite a lot of talk of stagflation, and I'm not sure I quite buy into it. What ultimately happens if you're going to have a slowdown in growth, a slowdown in demand, is you are also going to get a slowdown in inflation expectations. And we can see those 5-year break-evens now are back at the lowest point of the year, and now starting to challenge those lows made back in 22 and 21. In other words, yes, fine, tariffs near term will have a little bit of a bump up in this year's inflation expectations. The policy is not set based on this year's inflation, it's set on the medium-term expectation for inflation. So very, very much a case of I'm not sure the stagflation narrative is as strong as people make it out to be. I think that's very much just to sell newspaper articles. Also, don't forget if there's recessionary fears, you are of course going to get demand destruction, and that will bring inflation back down towards the target a lot quicker. Okay, and that's perhaps why investors are now becoming more confident putting on those rate cuts. Why? Because don't forget, the Fed's got a lot of room to cut to get to neutral. They've got in the region of about 100 to 150 basis points to cut, depending on where you think that neutral rate is. Okay, with that in mind then, that is our topic discussions for today. There's quite a bit going on in terms of the data. We of course have got US PMI data out, which will be closely watched because of course we have been seeing that continued weakening theme in particular PMI headline data. So keep a close eye on that. I think services is always going to be quite important for the market. We of course also have got OPEC out today, and we should get some news flow around that. But again, there's bigger things at play, which is, hey, we got these big ass tariffs in play now. What do they mean? What is going to be the retaliatory functions from the likes of China and EU? Are they going to come to the negotiating table? If they will, that'll be taken as positive. If they don't, and they choose to retaliate, and we see any form of, we're going to hit you with this, okay, all bets are off. You will see that VIX spike back up. If we get back above that 26s on the VIX and we start to move back up towards those 30, like I said, all bets are off. This correction is going to continue. It's going to deepen until such a point that we do get some positive narrative hitting the wires. All right, that being said, volatility is at a high. Don't second guess yourself. Don't try and be too clever. These are not markets. You want to be clever. Trade with the flow, because ultimately that is what's going to take us to all the key different trading levels. Okay, if there are any other questions, do post them in the Discord channel. Otherwise, good luck out there. Go manage that risk. Go make some money.